Another week and another batch of central banks are going to tell us all kinds of things about growth and inflation, and the market is in a holding pattern because one of these central banks will be the Federal Reserve, the one to rule them all. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we are going to look at what the Fed is going to do. We're going to look at what a couple of these other central banks are going to do, because there is a narrative forming here, and stocks probably won't like it. So let's begin with what we can surmise from the big kahuna here, the Federal Reserve. Then we'll jump to the Bank of England. Then we'll jump to the Bank of Japan. These are the three big ones up this week. As ever, if you're watching this on YouTube, jump in the comments. Let me know what you think. This way or that way on either one of these central banks, this way or that way on any of these assets that we're going to be talking about. Questions are, of course, fair game. Anything you'd like to comment in general is, of course, fair game, and we'll incorporate your thoughts into the show. So, what is the Fed expected to do here? Seems reasonable to start there, and there is a big 8% chance that they are going to do anything on rates. A commanding 2 basis points out of 25 are baked in. So needless to say, the market is very, very convinced that the Fed will do absolutely nothing at this meeting. If we look further downfield, we can see a cumulative 47% chance for a rate hike at some point this year. So about a 50-50 toss-up leaning in the direction of no change going forward. If we look at how much then is baked in thereafter, looking into next year's numbers, we can see there is the beginnings of an easing cycle starting to appear in expectations in June, but only just so. And this is something to take note of. As recently as a week ago, the likelihood of a cut in June was well over 50%. Now it's only about 58%, down from close to 70 or 80 recently. So the market is getting a little bit later in its vision for when this rate cut cycle starts. It's also getting a little bit more modest as to how many rate cuts we're going to get. By the end of next year, we can see 3 cuts baked in for a rate that is implied at 4.57, or down 75 basis points relative to current levels. That's the 75 basis points right there. That's the 3 cuts being baked in. That's 457 on the rate. So a little bit more modest than the 4 rate cuts we were expecting, again, as recently as a few weeks ago. But nevertheless, if we look at the way that the curve has generally moved in recent weeks, we can see not a whole lot of change. Relative to last week, not a whole lot of change. Even since the last Fed meeting, late July, after a slew of data, after Jackson Hole, not a whole lot different here. The front of the move, so call it from now to about 1 year out, has become a little bit flatter relative to when the Fed announced policy last, but not a whole lot of change here, not a lot of active speculation. So, why is this an important policy announcement? Well, the Fed, as ever, has an issue. In the orange there is the 12-month outlook on where the Fed funds rate is going to be. So, in other words, exactly a year from any given day. As we can see here, it's been generally stable since July. It's been oscillating a bit here and there, but it's basically anchoring around 4.75 to 5%. And isn't really going anywhere. What we've noticed here most recently, though, is inflation expectations. This is the 2-year break-even rate, the implied 2-year inflation rate baked into the bond market. The way that's derived is you take the difference between nominal and real rates, and then you get as the residual the inflation adjustment that got you from nominal too real. And you see this is perking up. Now, from the Fed's perspective, this is not a good thing, of course, because it's trying to keep inflation expectations contained. And this is now north of target. It was basically at the 2% target at the start of this month. No meaningful change in the rates outlook overall, and yet inflation expectations are high. Now, maybe this is a little bit of an influence from the rising price of oil, so maybe this is something the Fed can look through, because its main issue remains the service sector. Looking at the breakdown in inflation components here, we can see energy is becoming less of a drag. So those yellow bars on the bottom there are getting less deep, as it were. But the main issue is still the service sector. Services, excluding food and energy, are still the main catalysts for inflation by a long mile. So maybe this pickup in inflation expectations has to do with the recently rising price of oil, and maybe the Fed doesn't need to worry about that. But maybe it does, because the situation in the labor market, the last bit of the service sector where the Fed has agency, not necessarily the place where there is the most inflation. In the last numbers, that was, interestingly enough, auto insurance, largely echoing the same issue as there is in the housing market, which is illiquidity. Rates are so high that people don't want to buy things that they have to finance. And so there's a shortage for versions of those things, or a lack of supply for versions of those things that don't need financing, like existing homes and used cars. So people don't want to sell their homes, and so there's a very short supply of them. Inventories are down to multi-decade lows. And of course, that's keeping the price elevated. If nobody is selling, well, then the little demand that there is still has some issues, and the price is held up. It's the same story with cars. People don't want to buy new cars because that's expensive to finance, so used cars are kept, repaired, and are in general in short supply. People don't want to sell. They don't want to go and trade up. So there's a shortage. And because there's a shortage, and because more cars are being repaired rather than replaced, insurance bills are higher, insurance claims are bigger, so the cost of insurance is up. All of this, the Fed has very little agency to address because it is its own rate hikes that have largely created these situations. The labor market is a place where it can have some agency, because what it can do is it can slow the economy such that the demand for labor is reduced, and there's a further squeezing of that balance where, as we can see here, there is still about a 3 million and change deficit. What the Fed can do, obviously it can't make more labor supply. That's outside of its powers. But what it can do is cool demand such that the supply that's there is more sufficient to deal with the demand as it presents itself. Now we can see here, inflation has come down quite a bit at the headline, very dramatically, as a matter of fact, from 9.1 to now sub 4. But the employment cost index in the yellow there has come down much, much less than 1%, as a matter of fact, as of the second quarter. And that's because we have still this shortage, which of course means that employers have to compete on the only dimension that they can, wages. That makes the cost of labor higher. That makes the cost of everything that uses labor higher, and keeps inflation sticky at higher levels. So from the Fed's perspective, this is where there is still work to do. And from that perspective, then, is how we ought to evaluate why this FOMC announcement may or may not move markets. Because while the Fed is almost certainly not going to change rates, and the market is telling us that loudly, what they will also do is publish an updated set of forecasts for the key economic indicators, growth, inflation, unemployment, and also the policy rate path itself. All of the members of the market steering and policy making FOMC committee will be polled, and they will give their forecasts. And out of those, there will be averages. And we're going to get what's called the dot plot set of forecasts. So once we get that, if the message seems to be the Fed is going to downgrade growth expectations, but perhaps upgrade inflation expectations because these things are sticky, and then upgrade, most importantly, rate forecasts to suggest that although they are not hiking, they're going to have to hold rates higher here to keep this labor market squeeze from being disrupted and to continue to fight inflation downward, because again, now it is, as we can see here, north of target. Here's 2%. We can see over a 2-year window, we are now going in the wrong direction. If that's the message, well, then the market is going to look at this and say, how good of a thing is it that the Fed isn't hiking rates anymore when it's going to keep them this high at a time when the economy is slowing and growth is flagging? And that's probably not something that the markets are going to like. And it certainly is still something, even without an actual change in policy, with market moving potential. Hold that in your mind, because this will all come together into one story toward the end here, as we switch gears to look at the Bank of England. Now, here, we are almost certainly lining up for a hike. The market is assigning an 81% almost likelihood that there is going to be a rate hike this go around. 20 out of 25 basis points already baked in. So, where's the surprise element here? Well, these numbers have actually come down a bit, but more importantly, the Bank of England finds itself in much the same predicament as the ECB did when it reported policy last week. And the idea there is inflation expectations are inconveniently, let's say, rising, which is not, of course, what the central bank wants to see. We can see here in the yellow is headline UK CPI. In the dark line there is the 5-year break even. So again, this is the bond market's measure of inflation expectations. And we can see that inflation expectations are in fact going up. Not what the central bank wants to see when those inflation expectations seem to lead CPI by about 7 months. They portend inflation coming back up, disinflation stalling. And yet, the economy seems to be entering recession. Now, this is a little bit behind the Eurozone. They're looking at worse conditions still. They'll be gearing up for their 3rd month in contractionary territory. This is, as ever, PMI data centered around 50, where over 50 is growth, under 50 is contraction. And the further you go under 50, the faster the contraction. The further you go over 50, the faster the growth. Well, as you can see here, last month, all of the measures for the UK fell below 50. So the UK economy writ large is now contracting. The story here, much the same as it is for all major economies, the pop in the service sector at the start of this year fizzled sometime around May and has been unwinding ever since in every major economy. Not exceptional sort of condition here in the UK by any stretch of the imagination. So we see that we're looking at yet another set of these types of numbers. These are expected numbers due to be updated on Friday here, where we're going to get the latest set of these PMI readings. Again, all of them sub 50. So for the Bank of England, this is now a bit of a puzzle. Inflation expectations are demanding rate hikes, and growth considerations are screaming recession and saying, well, actually, we could use a bit of easing. We could use rates coming down to relieve some of the pain here. And again, as with the ECB, the main story here is that energy was the big inflationary influence last year and has faded. So this was basically the beginning of the war in Ukraine and the surge in energy prices that were linked into that. You can see that this, of course, is the housing, utilities, and fuels section, which includes most potently gas, which was the big source of this spike. But since then, we can see rapid disinflation because the price of natural gas has cratered. And so this is now dwarfed by a bit of an influence from the labor market side in the restaurants and hotels section. But really, it's a story about food inflation, much the same as it is in the Eurozone. And as we were looking at that part of it last week, we said, well, what's the ECB going to do with rate hikes to get people to want to eat less? Nothing. You can't really do that with monetary policy. And so instead, what the central bank might do is hike one last time because it's widely expected in the markets, and you kind of have to do that or the markets will be spooked. So it's essentially a performative hike, and then adjust the rhetoric to suggest you're about done or almost certainly done. You don't want to overcommit and say you're definitely done. You never know what's going to happen, but you do want to signal to markets at that point, this thing is going to stay higher for longer to maintain the squeeze, but there's not much else to be done from a policy perspective to deal with what's left of this issue. And that's seemingly where we're headed here with the Bank of England. In fact, Governor Andrew Bailey hinted as much last week when he told a whole bunch of members of Parliament in a hearing that rates are probably at a point where they don't need to be any more restrictive. And I'm paraphrasing, of course. It's also helpful that there's good indication that the food inflation concern has already peaked. So if we take a look at what's happening here with the UN World Food Price, and I can see that there's a typo there on the label. We'll address that in post. And global CPI, that's an aggregate that Bloomberg puts together, and you can see that there's about a 7-month lag there. So food inflation tends to filter into overall CPI, it looks like, with about a 7-month delay. And as you see the further declining of food prices here since the beginning of this year, you also then get the sense that maybe inflation is going to follow suit and continue to head lower. At the very least, the purple section here, which is food, the largest one, does seem to be starting to head back down. You can see that here to some extent. And indeed, here. So perhaps the Bank of England need not do more. Now, when the bank announces this, there does seem to be a strong possibility that the British pound takes it on the chin, because certainly that was the lesson to be learned from the ECB last week, and there is still a meaningful amount of tightening that is somewhat lingering. So you can see, again, about a 50-50 shot right here for a second hike beyond this one that is likely this week and fully priced in by November. If that starts coming out and rate cuts start getting closer on the horizon somewhere in here, as a consequence of what the Bank of England signals, that can certainly be very damaging for the pound. And finally, the Bank of Japan. No policy changes here, of course. No big shock there. Bank of Japan moves in 10 basis point increments rather than 25 basis points. You can see that right here. And so when you see one hike here being almost fully baked in going into early next year, that's 110 basis point hike. So you can see that we're expected to get off negative rates and get essentially back to even right around March or so. There's about a 50% chance in January, but it does get a little bit more convincing come March, and it's fully baked in come April. From there, things look fairly slow. It looks like by July of next year, we have a net change in rates of 15 basis points. So about 1.5, a little bit more hike. Now, all of this is quite a hawkish shift. The Bank of Japan, until relatively recently, was not expected to do anything on rates ever, or almost never, but certainly there was no active speculation. In fact, trying to bet on that has been called the widowmaker trade, because every time that speculation starts to build, it's almost always let down. But you can see that speculation here right in the yield curve. So relative to the last BOJ meeting on the 28th of July, there has been a pointedly hawkish shift here in the curve, suggesting the markets are priming themselves for the BOJ to do something that takes them off dovish extremes. Now, the general speculation seems to run they are going to first do away with yield curve control, which is the scheme they have to cap bond yields at the 10-year maturity. That will then set the stage for taking rates off negative territory. Now, that suggests that inflation is being looked at as enough of a built-in consideration for the Bank of Japan to really change tack on decades of policy, primarily motivated by demographic forces, none of which have turned. So, absent a change in those demographics, one might surmise that the need for action here arises from inflation that was baked in over the course of the pandemic and now needs to be corrected. Maybe that's the thinking in markets. The reality seems to be that, as everywhere, the issue is food. You can see it's much more so the case in Japan than even in the UK, because Japan is an island as well, but it imports more of its food and from more distant locations, at least for a decent part of the basket. And so we're looking at still a situation that the central bank does not have much agency over, and which is primarily imported. So this is perhaps not something that the BOJ is going to jump out the window on. There's been a lot of speculation after Governor Ueda said that maybe the Bank of Japan would have enough economic data to make a decision on which way to steer policy at the big level, sort of overall direction, come year end, which is quite a bit sooner than the year and a half that he guesstimated it would take when he took the helm in April of this year. But nevertheless, the markets ran away with the speculation that this would necessarily be hawkish. Markets got a little bit of a wake-up call on that. BOJ officials have since been firefighting. They've come out and said that Ueda was misinterpreted, that he's not meaning to say that we're going to have enough data for this directional change. He just means that we might have enough data. What that directional change will be, and if there will be a directional change, that's another question altogether. And there may not be one. So some pushback, some back and forth, but the markets clearly are imbued with the speculative spirit. And so if the BOJ doesn't do anything because they don't feel the pressure to, one might surmise that a weaker yen could be in the offing, but as with the ECB and probably the BOE, the currency response might not necessarily line up with what the central bank does. So the ECB, again, hiked, but signaled that they are not going to keep going, and the euro tanked. The Bank of England might do the same thing this week. The Fed might signal that they're not going anywhere, but that they're going to hold rates higher for longer because inflation remains an issue. And so you get this combination from Europe, dovish hikes, from the Fed, a hawkish hold. From the BOJ, it might be irrelevant standstill. Because if the BOJ finally does something after decades of easing with abandon, well, then there would be a change. But it hasn't clearly done enough because the yen is getting absolutely slaughtered in recent weeks. Again, because the question is that of yields. Now, if the Fed has opted not to hike and is instead opting for a hawkish hold, while Europe is opting for dovish hikes whereby they signal they're not going to keep going, why is that? Well, it's because the global economy is heading, as we've talked about here at length, into some kind of a recession. The U.S. economy is near standstill. China hasn't been able to get up on its legs since reopening from COVID restrictions in December, and the Eurozone is probably in recession already. So global growth is grinding down. We can see here global manufacturing already in contraction. Service sector peaked back in the latter first half of the year and has been slowing aggressively. Now nearing standstill at the latest reading of 50.6 for the composite. So that's the kind of an environment where central banks would start to back up. It's also the kind of an environment where you might have a situation where the yen might strengthen. And not because the BOJ is going to do anything that's necessarily hawkish. Rather, it's because the yen is primarily a creature of interest rates. Rates in Japan have been so low for so long that there has been a whole strategy made of borrowing cheaply in yen terms to then invest in higher yielding assets. So go borrow yen for essentially nothing, buy higher paying currencies and higher paying stocks, higher paying bonds, and extract the yield differential as income. But of course, when yields start to go down, then the difference and the margin of return to be had in that strategy starts to come undone. It works best when yield differentials are widening against Japan because it is as ever standing still and other central banks are hiking. Interest rates are rising globally. But if they stop rising, that might well be the cue to start unwinding this exposure. So to unwind short yen exposure de facto. Because, of course, if you borrow cheap yen for zero and then you want to go buy other assets, you need other currencies to buy those assets. So now that you have your pile of borrowed yen, you have to go trade that for a different currency, making you de facto short yen, which, of course, costs you nothing generally because you've borrowed at next to zero. But when you want to unwind that, well, you close whatever investments you have in the higher yielding assets. Now you have a pile of whatever currency. To pay down your yen loan that financed this, you have to go and exchange that currency for yen. You have to buy back the yen so you can pay down your yen loan. and that tends to make the yen go up. So if yields start to peak out and head lower because central banks are giving it up and there is a retreat, well, then inaction from the BOJ is not going to be keeping the yen from rising. And so it might be an interesting week here in that the dollar might be stronger though the Fed holds. The pound might be weaker though the Bank of England hikes. And the yen might be stronger though the Bank of Japan does nothing. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio, head of futures and forex here at Tasty Live, where we cover what's happened after the Wall Street close and how it might set the tone for what's to come. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sunday evenings, writing for the News and Insights section of tastylive.com, and opining on Twitter, yes, Twitter, because I'm stubborn, at Ilya Spivak. As ever, if you're watching this on YouTube, do jump in the comments, share your thoughts, and we'll incorporate them into the show. Macro Money will be back tomorrow. Hope to see you there. Take care.